I mean, when I picture the absolute pinnacle of modern finance, it's always something straight out of a sci-fi movie. You know, you imagine these trillion-dollar trading floor.
Oh, absolutely. The glowing screens everywhere.
Right. Supercomputers just churning out these incomprehensible algorithms. And literal armies of PhDs trying to predict, like, the exact millisecond a stock is going to tick up or down. It feels like this impenetrable fortress of technology.
It really does. I mean, Wall Street is an industry that absolutely prides itself on being the smartest, the fastest, and the most technologically equipped in the room.
Yeah.
They really want you to believe that without their massive mainframes, you couldn't possibly understand how money moves.
Right. But then you look at arguably the most successful investor in modern history, and his setup is, well, it's an older gentleman sitting in Omaha sipping a cherry Coke and reading a physical newspaper.
Exactly. No supercomputers.
No Manhattan zip code at all. And yet, Warren Buffett consistently beats those algorithmic models at their own game. So, welcome to our deep dive. Today, we are looking at the insights of Janet M. Tavakoli. She's a top-tier financial analyst who traveled exactly 1,269 miles from Wall Street to meet Buffett.
Yeah, and our goal today is to figure out how plain logic manages to outsmart the most expensive math in the world.
Right.
We are going to cut through the incredibly complex, jargon-heavy world of modern finance for you.
Because it is dense.
It is very dense. But by looking at Tavakoli's interactions with Buffett and her deep analysis of how markets actually operate, we're going to explore why a strict margin of safety and fundamental value investing consistently obliterate Wall Street's fanciest predictive models.
And look, whether you are managing your own retirement portfolio or you just want to understand the actual mechanics of how global markets operate behind the curtain, these insights are going to give you an entirely new lens for viewing financial information. Let's set the scene first. It's August 2005. The global economy is booming, but we are sitting right on the edge of the greatest market meltdown in history. And Janet Tavakoli is an expert in structured finance. In fact, the financial press dubbed her the Cassandra of credit derivatives.
Which is quite the title.
It is. But I have to ask, before we get into her predicting the crash, what exactly is a credit derivative? I mean, I hear that term thrown around all the time, but it just sounds like a random combination of intimidating financial words.
Honestly, it's actually a very simple concept that's just hidden behind complex branding. Think of a credit derivative as an insurance policy on a loan.
Okay.
So if a bank lends money to a company, the bank is obviously worried the company might default. So the bank buys a credit derivative from a third party. The bank pays a small premium, and in exchange, if the company goes bankrupt, that third party covers the loss.
Okay, so it's just insurance against a borrower going broke. That doesn't sound inherently dangerous.
Well, it isn't until you start betting on thousands of loans at once.
Yeah.
And then you start creating derivatives of derivatives without actually knowing if the underlying borrowers can pay.
Oh, wow.
Yeah. Tavakoli saw that the entire system was building these towering houses of cards based on really bad math. She kept warning that the credit bubble was going to collapse while, everyone else on Wall Street was busy partying and cashing bonus checks.
And that willingness to speak the uncomfortable truth is what caught Warren Buffett's attention, right?
Okay.
Because he invites her to Omaha for lunch. And her arrival at his office it's so beautifully human. It is the complete opposite of that intimidating Wall Street image we talked about.
It really is.
She walks into this unremarkable, buff-colored building. The lobby is totally empty. She gets in the elevator, goes up, steps out into a vacant hallway, and suddenly, a disembodied female voice from nowhere says, "Janet, make a right, and then another right, and go straight ahead."
It's a remarkably surreal entrance for the headquarters of Berkshire Hathaway. I mean,
Wow.
This is a multi-billion-dollar conglomerate.
It really is. And so she finally gets into Buffett's office, and he offers her a glass of water. She takes it, but as they sit down, she realizes her glass is just dripping with icy condensation.
Oh, no.
Right. She looks down at his pristine coffee table and is suddenly terrified of leaving a water ring. She's looking around frantically for a coaster, probably thinking she's going to ruin her one meeting with a financial legend.
The anxiety must have been intense.
But Buffett instantly senses her anxiety. He literally grabs his own unread, pristine copy of the Wall Street Journal, tosses it onto the table, and tells her to put the dripping glass right on top of it. He couldn't relax until she relaxed.
That is such a great detail, and that highly observant, deeply human interaction perfectly mirrors his approach to investing.
How so?
Well, Tavakoli describes Buffett's mind as a memory palace. He pays attention to reality, to human behavior, and to tangible businesses. He completely rejects the academic theory that stock prices perfectly reflect all known information.
Right.
And most importantly, he refuses to use Wall Street's beloved Monte Carlo simulations.
Okay, I want to stop on that because I have heard that term. Wall Street relies heavily on these Monte Carlo models to price all those complex derivatives we just talked about. How do those models actually work, and why does Buffett hate them?
So think about flipping a coin or rolling a pair of dice.
Okay.
You know exactly what the possible outcomes are. A six-sided die has exactly six sides. A mathematical model can perfectly describe all potential outcomes and probabilities because the inputs are absolute facts.
Right.
That is what a Monte Carlo simulation does. It uses computers to run thousands of random scenarios based on known variables to predict an outcome.
Right, so it's like simulating a million hands of blackjack to find the optimal betting strategy.
Precisely.
Yeah.
But the fundamental problem is that in finance, you actually don't know the inputs. The economy is not a six-sided die.
No, it's a lot messier.
Exactly. When Wall Street runs a Monte Carlo simulation on a massive bundle of corporate loans, they are guessing at the probability of a company defaulting. They are guessing at how one company's failure might drag down another company in a completely different industry.
So the supercomputer might spit out a risk probability to like 9 decimal places, making it look incredibly scientific and precise.
Yes.
But it can't tell you that the underlying assumptions typed into the computer are just completely wrong.
That is the fatal flaw. It is an illusion of precision. Investment banks use these heavily flawed models to price highly complex contracts. But because these contracts are so unique and convoluted, there's no open market for them.
You can't just look up the price like you can with a share of Apple stock.
Right. Normally, assets are marked to market, meaning their value on the balance sheet is whatever someone else is willing to pay for them today. But as Buffett points out, because these derivatives rely entirely on theoretical models, they aren't marked to market. They are marked to myth.
Marked to myth. That is such a great phrase. You just invent a value based on your own computer's fantasy.
Exactly.
And the genius of Buffett isn't just that he avoids this bad math. He aggressively uses it against Wall Street. Tavakoli details this incredible trade where Buffett takes massive upfront premiums from investment banks to write 20-year equity index put options.
Which is a huge bet.
Basically, he guarantees the banks that if the global stock markets are lower in 20 years than they are today, he will pay them out.
And you have to look at why Wall Street was so eager to make that trade with him. The investment bank's mathematical models are obsessed with short-term volatility.
Okay.
The models look at the immediate fluctuations and price these 20-year options as if there's a highly realistic chance that the entire global economy will be stagnant or lower 2 decades from now. They completely fail to account for long-term compounding economic growth.
Which makes zero sense to me. I mean, it sounds like trying to predict the future net worth of a Harvard MBA class 20 years after graduation, but you base your entire calculation purely on the salary of their very first entry-level job.
That is exactly what it's like.
You are completely ignoring their whole trajectory of promotions and investments. But why would the bankers on Wall Street agree to this? Don't they know the economy grows over 20 years?
They probably do, but their incentive structure just blinds them. The traders at the investment banks get their multi-million-dollar bonuses this year based on the trades they execute today.
I see.
They do not care what happens in year 20. So they rely on the flawed model because it justifies the trade right now.
Wow.
Buffett looks at this and sees highly irrational behavior. So he gladly takes billions of dollars in cash premiums from them on day one. He invests that cash into his own businesses for 20 years, generating massive returns, knowing full well that in 2 decades, the markets will likely be significantly higher and he won't have to pay out a dime.
It's incredible. If all these Wall Street quants with 140 IQs are running these massive simulations, it really begs the question, what is Buffett's model?
Well, Buffett doesn't use a model. Buffett is the model.
I love that.
He relies on rational assessment, historical context, and a principle he learned from his mentor Benjamin Graham, which is the margin of safety. He actually reads the grueling financial reports.
Your actual paper reports.
Yes. He understands how the specific businesses generate cash. And he only makes a deal when the price is so heavily skewed in his favor that it creates a massive cushion against unexpected disasters. He doesn't guess at inputs. He demands an undeniable reality check.
But if the mathematical models on Wall Street were just dangerously detached from reality, it feels like that environment of complex, unquestioned numbers created a perfect smokescreen for something much more malicious.
Oh, absolutely.
Because when we look at corporate leadership during this era, they weren't just making innocent math mistakes.
Not at all. The opacity of these financial mechanisms became a weapon. Corporate executives realized that if the math was too complicated for the average shareholder to understand, they could use that complexity to essentially guarantee their own vast wealth directly at the expense of the very companies they were hired to run.
Here's where it gets really interesting, because this leads right into the stock option backdating scandal, which I found to be one of the most maddening parts of Tavakoli's analysis.
It is infuriating.
So employee stock options are supposed to be an incentive, right? Board says, hey, here's an option to buy stock at today's price of $50. If you do a great job running the company and the stock goes to $100, you make a fortune.
Right. That aligns the CEO's interests with the shareholders.
Exactly. But that is not what was happening, was it?
No, it wasn't. Executives at over 100 major companies figured out a way to remove the risk entirely. Instead of taking the options at today's price, they were secretly looking backward in time.
This blows my mind.
They would look at the stock chart for the past year, find the absolute lowest point the stock ever hit, say $20 a share, and retroactively grant themselves the options at that historical low.
Wait, if these executives are essentially changing the rules of the game after it's played, isn't that like going to a horse race, waiting until all the horses have crossed the finish line, and then placing your bet on the winner, just pretending you made the bet before the race started?
That is a perfect analogy. It's guaranteed millions in profit for doing absolutely nothing. Tavakoli was so disgusted by this rewriting of history that she created a sarcastic award called the Golden Fleece Award for optional integrity to mock these CEOs in the press.
Which is brilliant.
It was blatant theft of shareholder wealth. I mean, every dollar of profit the executive guaranteed for themselves through backdating was a hidden cost to the company. But the most shocking part of this scandal wasn't the greedy CEOs. It was the fact that prominent voices in academia rushed to defend them.
That threw me completely. Why on earth would famous, Nobel-winning economists defend hiding this from the shareholders?
It comes back to that dogmatic academic theory we mentioned earlier, the efficient market hypothesis. Famous figures like Milton Friedman and Harry Markowitz actually signed commentaries arguing that forcing companies to clearly expense these employee stock options on their accounting statements was improper.
But how could transparency be improper? That makes no sense.
Because they believed so fervently in their models. They claimed that the market is perfectly efficient and that sophisticated investors somehow already knew how to calculate and value these hidden liabilities, even if they weren't explicitly written down on the balance sheet.
Right.
They essentially argued that making the accounting transparent was redundant and would just confuse people.
That is wild. It's academic theory just completely overriding basic common sense.
It really is.
Buffett, of course, had absolutely zero tolerance for this behavior. When the scandal broke, he circulated a memo to his own Berkshire Hathaway managers. He told them that defending unethical behavior by claiming it's normal is the fastest way to ruin a reputation. He wrote that the 5 most dangerous words in business are, everybody else is doing it.
That phrase, everybody else is doing it, is the psychological engine behind almost every financial disaster.
Yeah.
And that mentality of getting extraordinarily rich without actually adding any tangible value to the economy, well, it wasn't just isolated to a few greedy corporate boards. It became the entire foundational business model for Wall Street's ultimate status symbol, the hedge fund.
I am so glad we were getting into this because the aura around hedge funds is just so strong. They are portrayed as these exclusive clubs for absolute financial geniuses who see things regular people can't. But Tavakoli systematically dismantles that illusion.
She really does. And to understand why the illusion is so dangerous, we have to look at how hedge funds actually operate, beginning with the spectacular collapse of long-term capital management, or LTCM.
Right.
In the late 90s, LTCM was the biggest hedge fund in the world, and it wasn't run by street-smart traders. It was literally run by Nobel laureates in economics.
Which is crazy to think about. I know they collapsed, but how does a room full of the smartest economic minds on the planet blow up a multi-billion-dollar fund?
Because of leverage.
Yeah.
They were using those exact same Monte Carlo models we discussed earlier. Their models would find tiny, supposedly risk-free discrepancies in global bond prices.
Okay.
But because the profit margins on these trades were microscopically small, they had to borrow massive amounts of money leverage to make the trade worthwhile. They were leveraged at ratios of 25 to 1, sometimes much higher.
So if they have $1 of their own money, they are borrowing $25 from a bank to place the bet, which means if the market moves against them by even a tiny fraction of a percent, their original dollar is completely wiped out.
Exactly. And when an unpredictable event happened, in their case, the Russian financial crisis, their models just broke down. Reality didn't match the math. Because they were so heavily leveraged, they lost billions practically overnight and had to be bailed out to prevent a global banking crisis. Meanwhile, during that exact same period, Warren Buffett's Berkshire Hathaway, which uses almost no leverage and relies on fundamental cash flows, just kept steadily compounding value.
Yet despite LTCM going up in flames, billions and billions of dollars continue to flood into hedge funds today. How do they keep convincing people to hand over their money?
It's the allure of exclusivity, combined with an incredibly aggressive fee structure that heavily penalizes the investor. Traditionally, hedge funds operate on a 2 and 20 model.
Okay, what does that mean?
They take a 2% management fee on the total assets just for existing and 20% of any profits they generate. But Tavakoli notes that some of the top-tier funds demand a massive 5% management fee and take 44% of the upside.
So let me unpack this. Investing in some of these funds is like paying a guy a massive non-refundable fee to take your wallet to Vegas.
Pretty much.
If he happens to win at the blackjack table, he keeps almost half of your winnings. But if he loses your entire wallet, he still keeps his massive upfront fee and walks away fine. How is this considered a sophisticated investment?
Mathematically, active trading is largely a zero-sum game. For every active manager who beats the market average, someone else has to underperform it. The only reason the hedge fund industry appears to have a high success rate is due to statistical illusions.
Like what?
Well, first, there's survivorship bias. When a hedge fund blows up and loses everything, its terrible track record is quietly erased from the industry databases. You only see the records of the survivors.
Oh, wow.
Second is creation bias. A new fund will trade quietly for a few years, and they will only report their historical returns to the public if they happen to go on a lucky winning streak.
It's a completely manufactured track record. But you mentioned the Vegas analogy earlier, and it makes me wonder, if the fund manager gets to keep his fee no matter what, why do they blow up so spectacularly? Why not just play it safe and collect the 2% every year?
Because of a powerful psychological flaw known as loss aversion. Tavakoli leans on the Nobel Prize-winning research of psychologists Daniel Kahneman and Amos Tversky.
Right, behavioral economics.
Exactly. They proved that human beings feel the pain of a loss roughly twice as intensely as they feel the pleasure of an equal game. Consequently, people will take reckless, completely irrational risks simply to avoid locking in a loss.
I see. So the hedge fund manager who is having a bad year knows that if he sends a letter to his clients reporting a loss, the clients will pull their money out, the exclusive reputation dies, and that massive guaranteed fee income vanishes.
Exactly right.
So instead of admitting defeat and taking a small hit, he borrows more money in his clients' names and doubles down at the roulette table, praying for a miracle.
Precisely. And when that miracle doesn't happen, the desperation leads to outright fraud. Tavakoli highlights the unbelievable story of Samuel Israel, who ran the Bayou Group hedge fund.
Oh, this story's wild.
It really is.
Yeah.
He had terrible trading losses. Instead of admitting it, he created a massive Ponzi scheme, printing fake auditing reports to show his investors fake profits while he frantically kept gambling to make the money back.
And when it finally unraveled and he was sentenced to 20 years in federal prison, his response was just pure panic. He actually tried to fake his own suicide. He drove his SUV to a bridge, abandoned it, and literally wrote "Suicide is painless in the dust" on the hood of the car before fleeing in an RV. I mean, he was caught shortly after, but it's just such a bizarre, darkly cinematic ending.
It perfectly illustrates the sheer madness that leverage and loss aversion create. Tavakoli captures this phenomenon with a brilliant literary analogy. She points to a D.H. Lawrence short story called The Rocking Horse Winner.
Right.
It's about a young boy who discovers that if he frantically rides his wooden rocking horse to the point of exhaustion, he will receive magical visions of which real horses are going to win the upcoming races.
Right. And he uses the visions to win money for his family. But it's never enough. The house just keeps whispering to him, "There must be more money. There must be more money."
Yeah.
So he rides the rocking horse harder and faster, trying to force more luck until he literally collapses and dies from the strain.
It is the ultimate metaphor for the modern hedge fund industry. They are frantically riding the rocking horse of borrowed money, constantly hearing the market demand higher returns to justify their outrageous fees, pushing themselves further and further out on the risk curve until the inevitable catastrophic crash.
Which perfectly sets the stage for the grand finale of this entire financial horror show.
It really does.
We have Wall Street relying on mathematical models that are completely disconnected from reality. We have a corporate culture where everybody's doing it justifies hiding massive liabilities. And we have an entire ecosystem of hedge funds using extreme leverage to gamble on tiny margins.
And when you collide all three of those toxic elements, you get the exact mechanism that triggered the 2008 global mortgage crisis.
The perfect storm. And what's amazing is that Buffett saw the core rot of the mortgage crisis years before anyone else, simply by looking at actual businesses instead of computer screens.
Yes, he did.
Back in 2002, Berkshire Hathaway bought the distressed debt of a bank-manufactured housing company called Oakwood Homes. Buffett got to look under the hood of the subprime lending industry, and he was horrified by what he saw.
Because he realized the underlying mechanism was entirely predatory. He famously summarized the entire subprime mortgage model as buyers who shouldn't have bought, financed by lenders who shouldn't have lent.
Which is perfectly put.
Oakwood was aggressively pushing terrible high-interest loans onto vulnerable people who had no realistic way of making the payments. But Oakwood didn't care if the borrower defaulted, because Oakwood wasn't keeping the loans. They were passing the risk up the financial food chain.
Right, and this is where Wall Street's obsession with complex securitization comes in. Can you explain how that securitization mechanism actually worked? I mean, how did a bad loan in a trailer park bring down global banks?
Well, securitization is essentially a massive financial blender. Investment banks, like Credit Suisse, were providing the initial cash for these predatory lenders to operate. The banks would take thousands of these terrible individual mortgages, throw them into the blender, and chop them up into complex, layered bonds.
Okay.
They would pay the credit rating agencies to stamp these new bonds with a AAA rating, making them look as safe as U.S. Treasury bonds. Then they would sell pieces of this blended smoothie to those so-called sophisticated institutional investors.
So securitization in this case sounds exactly like taking rotten ingredients, tossing them into a blender, and convincing investors they're buying a premium health smoothie.
That is exactly what it is.
But the blender, the investment bank, still gets paid its fee no matter how sick the customer gets, right?
Exactly. The system completely separated the risk from the reward, which destroyed any incentive to verify the quality of the loans. But this is where Tavakoli introduces her fundamental law, which she calls the theory of everything in finance.
Okay, what is that?
It strips away all the math and all the jargon. The theory states that the true value of any financial transaction relies strictly on four physical realities: the timing, the frequency, the magnitude, and the probability of cash flows.
Okay, let's break that down practically. So if I have a mortgage, the timing is that my payment is due on the first of the month.
Right.
The frequency is monthly. The magnitude is, say, $2,000. And the probability is the likelihood that I keep my job and actually write the check.
Exactly. Wall Street was using Monte Carlo simulations to pretend the probability of millions of people paying was high.
Yeah.
But if you actually looked at the borrowers, the probability of them making those payments was near zero.
Wow.
And here's the unbending law of finance. It does not matter how complex your math is or how fancy the acronym on your securitized bond is. A computer model cannot magically conjure $2,000 out of an empty bank account.
No, it can't.
You cannot outsmart bad cash flows. When the actual human beings at the bottom of the chain stopped paying, the real probability dropped to zero, and the entire multi-trillion-dollar structure collapsed.
That is incredibly clarifying. I mean, they built a tower out of theoretical math, and it shattered the second it hit physical reality.
Exactly.
So, bringing this all together for you, the listener, what is the ultimate takeaway? If we trace this entire journey from that quiet, empty lobby in Omaha to the chaotic collapse of the global economy, how do you actually protect yourself?
Well, you have to cultivate Warren Buffett's mindset in your own financial life. First, you must demand absolute transparency. If an investment or a compensation plan requires a 50-page manual to understand, you walk away.
Yep.
Second, you have to actively ignore the herd. When everyone around you is getting rich on speculative bets and telling you everybody else is doing it, you have to have the discipline to stay grounded in reality. And finally, you must insist on a margin of safety based on actual verifiable cash flows, not theoretical models.
Never, ever invest your money in a black box that you don't fully understand, regardless of how many Nobel laureates or Wall Street wizards are telling you it's a sure thing.
Exactly. And before we close, I want to leave you with one final, deeply unsettling reality from Tavakoli's analysis.
Okay.
We discussed how hedge funds are generally allowed to operate in the shadows, using extreme leverage with zero regulation. The legal justification for this is that hedge funds are restricted to accredited investors. Millionaires, billionaires, and massive institutions who theoretically possess the financial sophistication to understand the extreme risks they are taking.
Right. The government's logic is basically, if a billionaire wants to ride the rocking horse and lose his yacht, that's his own fault.
Precisely. But here is the catch that Wall Street doesn't advertise. Some of the largest institutional investors in the world are public pension funds.
Oh, no.
These are the entities managing the retirement savings of public school teachers, firefighters, and everyday corporate workers. Desperate to hit high-return targets, these pension boards actively allocate vast sums of that everyday retirement money into these exact same high-fee, highly leveraged, unregulated hedge funds, which forces you to ask a very uncomfortable question.
Oh, wow.
If your standard 401k or your state pension is quietly being funneled into these opaque Wall Street gambles to chase yield, are you, without even knowing it, the one who is actually riding the rocking horse?
That is a chilling thought. We all might be on the horse without ever buying a ticket. Thank you so much for joining us on this deep dive into the realities of Wall Street. Keep asking the hard questions, demand to see the actual cash flows, and always, always question the consensus. See you next time.